Hey everybody, Scott DiGregorio, your mortgage guy. Again, I'm reaching out to self-employed people. So have you ever thought to yourself, man, I'm self-employed, I can't get a mortgage? Have you ever heard that lie? Have you ever heard that crap? Here's the deal, it's not true, okay? You can absolutely get a mortgage, but you gotta understand the way a lender calculates self-employment income. So I'm not gonna get too technical with you here, but what we work on, we take the taxable income, and then there's certain things we could add back in. We could add back in depreciation, for example, and there's a whole separate video on how that works. But we take your bottom line, okay? If the income is the same or increasing, we do a 24-month average. If the income is decreasing, we do a 12-month average, okay? So there's a half dozen or a dozen other variables. I don't want to get too in the weeds here in the video, but please understand that we're going to take your last 2 years' tax returns, personal and business, and we're going to apply a formula off of them. So please be careful in the way you write things off. There's certain things we could add back in, one-time expenses like you buy a truck or a piece of equipment. We could add back in depreciation. Things like there's something called the Section 179 deduction that we could add back in, which is a form of depreciation. There's things we can add back into your income. So it's real important that you're knowledgeable about that before you file your taxes, because once your taxes get filed, you're living with them for 2 years, and that's the way it is. Now, there are programs out there now where we could use bank statements in lieu of tax returns for income. You are going to pay a higher interest rate on those, but it's a good program for some people. So that's what I got for you. Scott DiGregorio. Catch you in the next video. Take care.